Today's discussion centers squarely on the efficacy and, well, the long-term consequences of central bank liquidity injections, particularly after a global financial crunch, and how these actions interplay with current international economic divergences. My position today is that historical patterns, I believe, unequivocally demonstrate central bank interventions provide essential, albeit perhaps temporary, stability, inevitably leading to, predictable market rebounds.
And I'll be countering that view. My argument is that such interventions, while yes, certainly predictable in their occurrence, ultimately mask or reconfigure underlying systemic risks. I think they contribute to deeper, maybe more insidious forms of wealth transfer, what I tend to call the great taking through inflation. And they perpetuate structural fragility within the global system rather than truly resolving, the fundamental imbalances.
Okay, so let's start by looking at the historical record, which, in my view, paints a very clear picture. Liquidity crunches, whether they're sparked by major institutional failures or even, say, the collapse of a country's financial system, are fundamentally temporary, at least in their acute phase. We've seen this pattern repeat itself time and again. Initially, there's a broad market panic where, everything goes down, including gold and gold mining stocks, as investors just rush to cash, right? But then, almost without fail, central banks step in and reflate the system through what can really only be described as a significant printing spree. Think back to 2008. Gold, a traditional safe haven, dropped nearly 30% during that initial market collapse, only to surge back powerfully, eventually reaching almost 3 times its pre-crisis peak by 2011. Similarly, in March 2020, we saw these rapid, dramatic market declines quickly met with, frankly, unprecedented intervention from the Federal Reserve. This demonstrates a clear, almost ironclad truth. Central banks will always choose inflation over deflation. They prioritize economic activity and employment stability, even if it means some level of currency debasement. This choice invariably leads to a predictable rebound for real assets and, importantly, major mining stocks, which, as history shows, tend to track gold's eventual surge. From an investor's perspective, the crucial lesson seems clear. One must endure the short-term volatility because liquidity and, with it, market value, it always seems to return.
Well, it's certainly true that central bank interventions have become a, shall we say, predictable feature of our financial landscape. I'd argue, though, that their impact extends far beyond just mere stabilization. This seemingly benevolent printing spree, as you called it, fundamentally constitutes what I refer to as the great taking through inflation. It's a silent, quite insidious debasement of wealth that transfers value primarily from savers and fixed income earners without ever making headlines or requiring explicit legislative action. It's a constant erosion of purchasing power, like a stealth tax on accumulated capital. Furthermore, the supposed stability these interventions offer often overlooks and I think in some cases actually exacerbates deep structural fragilities that these liquidity injections simply don't address. Consider, for example, the intricate and, frankly, precarious state of economies like China. They are characterized by pervasive ghost towns, these vast, empty residential developments, an undeniable and monumental real estate bubble, and enormous holdings of American dollars which we're going to default on effectively through our own inflationary policies. China's recent injection of $1 trillion yuan through a reverse repo operation where their central bank sells securities to commercial banks with an agreement to buy them back later, basically providing short-term liquidity. This isn't just a reactive measure to some new sudden crunch. It signals, I believe, existing and deep-seated stress already brewing within their system. This indicates that liquidity, while yes, it's flowing, it doesn't resolve these fundamental systemic issues, nor, for that matter, does it address what I see as the real threat for individual investors, the issue of rehypothecation at the brokerage level, where courts, historically, they defend the system over individual investors. This is, I think, a crucial distinction from the macro-level interventions.
I hear your concerns about the long-term perhaps insidious effects of inflation and the structural issues you identify in places like China. That's fair. However, I'd offer a slightly different perspective on the temporary nature of liquidity crises. My point is really about the acute phase. Markets, as we saw, in March 2020, they plummeted 30% in just a matter of weeks. The fear was palpable, almost apocalyptic, right? Yet they rebounded sharply and rapidly once the Federal Reserve unleashed trillions in bond purchases and other liquidity measures. This isn't just a one-off. It feels like an established pattern now. It suggests that while having short-term cash certainly offers immediate protection during these sudden drops, it's real assets, commodities, sound businesses, and yes, major mining stocks that truly guard long-term value against that very inflation you describe. Investors who can withstand the volatility, who don't panic sell, will ultimately see markets go back up again. The reason is simple, I think, and consistent. Central banks are always poised to reflate. The alternative, a deflationary spiral, is just seen as politically and economically untenable.
That's an interesting point regarding the immediate market rebound. And you're right, the speed can be astonishing. However, I would frame that temporary nature of market drops and the subsequent reflation in maybe a different light. This rapid recovery subtly obscures what I still believe is the silent debasement of the great taking through inflation. This isn't a one-time event. It's an ongoing process. Every year, this debasement quietly, almost imperceptibly, transfers wealth from savers, from pensioners, from those on fixed incomes to those with hard assets or access to newly created credit. It's a constant recalibration of value. Furthermore, when we look at China's recent, $140 billion injection via their reverse repo mechanism, its timing and sheer scale are, unusual.
Right.
It's not just a response to a new external shock. It strongly suggests underlying financial stress already brewing within their domestic system, perhaps, as many suspect, from their property sector or local government debt. These liquidity injections, then, aren't merely reactive measures to new crises, but are becoming an ongoing, almost necessary feature in a global financial system that is arguably rife with fundamental imbalances, constantly requiring more and more liquidity just to paper over deeper cracks. So, are we truly solving problems, or are we just continually kicking the can down the road at the cost of genuine value preservation for many?
Well, I'm not fully convinced that these interventions solely mask issues, especially when we consider the long-term value proposition for certain assets. You mentioned the ongoing silent debasement, and I agree inflation is a factor, but that very factor, I think, underscores the importance of real assets. Take miners, particularly the major established producers. They really shouldn't be viewed as short-term liquidity plays. Their purpose is precisely to magnify your investment 5 to 10 years down the line, because at their core, they are producing actual money, gold and other precious metals, and many are currently so undervalued relative to their output and, the global money supply. History is remarkably clear on this. Major producers have consistently tracked gold's surge post-crisis. After the 2008 downturn, we saw a staggering 180% increase in the value of gold miners from 2008 into 2011. This isn't some distorted reality or a speculative bubble. It's a fundamental value proposition tied to the production of a tangible asset that retains purchasing power, especially when central banks are, actively pursuing inflationary policies.
That's a compelling argument for the long-term value of miners and gold as an inflation hedge. I'll grant you that. But have you considered how systemic distortions can impact even something as tangible and historically stable as gold? The value of gold in miners, while rooted in real assets, it's not immune to large-scale, non-market disruptions. What if, for instance, China were to suddenly reveal they have 30,000 tons of gold, a figure vastly exceeding official declarations, maybe accumulated through clandestine means over decades?
Okay.
Such a revelation would immediately create just a dramatic divergence in global markets. Prices in China, measured in gold terms, would likely become sky high as their population and institutions would rush to acquire this newly transparent domestic gold supply. Simultaneously, prices everywhere else are going to drop like a rock Why? Because the rest of the world needing to rebalance trade and acquire this newly acknowledged gold would be forced to sell products to China at incredibly low prices, essentially to buy their gold. This dynamic would, I think, inevitably collapse Chinese industry, which currently relies on being a low-cost producer for the world. So while miners are indeed producing actual money, that doesn't guarantee stability or even profitability when global trade balances are disrupted by concentrated government hoards of gold that can quite literally destabilize economies. Gold as a hedge for an individual is fundamentally different from a government holding it in such a quantity that it could potentially be weaponized. You see?
I hear your concerns about potential distortions from large undisclosed gold hoards and the systemic shock that could entail. It's a dramatic scenario. However, let's maybe pivot slightly and consider what I believe is the real barrier to a great taking in the traditional sense. A direct, outright seizure of assets, which some people worry about in times of crisis. My argument is that it isn't primarily legality, it's political survival. Consider the ownership structure of wealth in the U.S. Over 88% of U.S. equities are held by the top 10% of the population. Any outright seizure, or even a serious hint of it, would directly strike the wealthy donor class politicians depend on for their campaigns, their influence, their very power base. Such an act would be just politically really bad for any ruling party, potentially leading to immediate and widespread backlash from those who exert significant political influence. Therefore, the more realistic taking isn't some dramatic, overt confiscation. It's, as you've pointed out, already happening, precisely through the inflation you've highlighted, the diluted purchasing power, and the selective bailouts we experience constantly. This approach doesn't directly alienate the most powerful political actors in the same way, you see? It's a more diffuse and less visible form of wealth transfer. It's perhaps about maintaining a political equilibrium while still addressing systemic pressures.
I'm sorry, but I just don't buy that the political will of the wealthy or the fear of alienating them is the sole or even primary safeguard against a taking. While your point about political survival is certainly valid for a direct government raid on portfolios, I really believe that focus overlooks a far more insidious and, frankly, immediate threat already embedded within the financial system itself: Wall Street rehypothecation. This isn't some hypothetical government action. It's an everyday practice. Rehypothecation is where brokers take your stocks, which you believe you own and are held safely in your name, and use them as collateral for their own borrowings and trading activities. Essentially, they are pledging your assets to cover their firm's leverage. In a deflationary crash or a serious liquidity crunch, counterparty chains unravel fast, and the legal claims over these rehypothecated assets consistently tilt toward institutions, not individuals.
We witnessed the devastating consequences of this during MF Global's collapse back in 2011.
Right, I remember that.
Yeah.
There, hundreds of millions of dollars in supposedly segregated customer accounts were found to be misused, essentially raided, to cover the firm's own obligations when they went bankrupt. Individual investors were left in limbo, often for years, as courts historically tend to defend the system and prioritize institutional claims rather than the individual customer's ownership rights. Central bank interventions, while providing macro liquidity, do not resolve this fundamental custody risk. They simply inject money into a system where underlying ownership structures can be incredibly fragile and opaque, leaving the individual investor vulnerable regardless of the broader reflation happening at the macro level. Okay, while that rehypothecation risk is certainly an important and, yes, alarming structural concern for individual investors, and you've made a compelling case with the MF Global example, I still believe the broader global interdependence ultimately overrides many localized issues and even these specific custody risks, at least in terms of macro financial stability. When we consider the global economy, there's a fundamental division of labor, right? The West primarily functions as consumers, driving demand, and China as a major producer, supplying goods. This means that fundamentally, when the West falls, China falls with it. Their economies are deeply interconnected and reliant on these demand cycles. When global demand inevitably breaks down, as it did in 2008 and again in 2020, it leads to synchronized central bank responses and a global reflation cycle. Neither major economic bloc can really afford the other to collapse completely, because the ripple effects would just be catastrophic for both.
This interdependence creates a strong incentive for coordinated liquidity injections and a return to some form of equilibrium, albeit maybe a new one.
I suppose I just come at that idea of global interdependence and synchronized responses from a very different perspective now. The notion that the West's and China's economies are operating on similar underlying realities, leading inevitably to synchronized central bank actions, is, in my view, becoming increasingly outdated. China's economy has been so fake for so long, plagued by these pervasive ghost towns, entire cities built on speculation that remain largely empty, and an unsustainable real estate bubble that constitutes a vast portion of household wealth there. And crucially, their interest rates are going down and down and down as they try desperately to stimulate a flagging domestic economy. Meanwhile, the West's rates, particularly in the U.S., are going up and up and up to combat inflation. This represents a significant and I think growing divergence in monetary policy and underlying economic health, distorting global capital flows and creating unique, deep-seated vulnerabilities specifically for China. The collapse of their property sector, which, remember, has been the main savings vehicle for countless households, combined with the risk of a de facto U.S. dollar default through our own relentless inflation, well, it means China faces unique, almost existential challenges. These are fundamental structural issues that near liquidity injections from their central bank or even coordinated global efforts won't fundamentally fix. They feel like symptoms, not solutions, to a system teetering on potentially very different foundations than ours.
Well, our discussion today really highlights, I think, that while central bank liquidity injections are consistent and a predictable mechanism for reflating the system after a liquidity crunch, offering that temporary reprieve and bringing predictable market movements in the short term, they also introduce complex, potentially destabilizing dynamics within the global financial system. For investors, understanding this powerful cycle and distinguishing between those temporary acute market drops and the long-term inflation hedging value of real assets remains, I believe, paramount for navigating future volatility.
Indeed. Although central bank interventions are an undeniable and, yes, recurring feature of modern finance, it is, I feel, crucial to recognize their deeper, often unacknowledged implications. These actions frequently reconfigure rather than genuinely resolve systemic fragilities. They actively create what I've termed the great taking through inflation, and consistently fail, it seems, to address fundamental structural risks like rehypothecation. This leaves the global economy susceptible to new and insidious forms of instability, despite the seemingly endless provision of liquidity. It really forces observers to consider whether the stability these interventions claim to provide is truly achieved or if it is merely postponed, often at the cost of new and more complex risks emerging in the background that these interventions don't inherently, fix.